Do you remember the last time you sent money to someone? Maybe it was a quick 100 dirhams transfer to a friend and it showed up instantly on their phone. But have you ever paused to wonder what actually happens in those few seconds? What kind of communication is flying between your bank and theirs? Is your money physically moving somewhere? Or is it going through 3 different banks? Or is it just an accounting magic? Here's the thing, there's a lot more going on than it looks. Because while it may seem instant, behind the scene, banks are often relying on old school infrastructure, especially when the two banks are not the same. Sometimes money takes a detour through intermediary banks, passes through nostro accounts, gets stuck in the clearing queues. It's complex, it's messy, and it's expensive. So before we talk about stablecoins or the future of money, let's first try to understand how money actually moves today through the traditional banking system, however broken it is. Only then we can appreciate what innovation is really trying to fix here. Let's start from understanding how local money transfers work. Let's take an example, a payment happening within the same bank. Let's suppose there are two friends, Alice and Bob. Alice wants to send 100 dirhams to Bob. They both bank with Bank A. Since they both bank with the same bank, Bank A simply deducts 100 from Alice's account and adds it to Bob's account. No money leaves Bank A. It is just a digital book entry. That's why these transfers are instant and more recently 24/7. Now let's make it a little more interesting. Case 2. Payments between two local banks. Not the same bank, two different banks. Now let's say Alice is with Bank A, but Bob is with Bank B. Now, when Alice wants to send money to Bob, Bank A deducts 100 from Alice's account and tells Bank B to credit to Bob. But wait, why would Bank B do that? They haven't received anything from Bank A. So should Bank A send a bag full of cash to Bank B or something else? That's where the interbank clearing system comes in. What we're now going to see is how do banks settle their interbank balances. So basically, banks settle their interbank balances in two main ways. One is through correspondent banking, nostro accounts, and number 2, the central bank clearing system. Let's first talk about how do banks move money between each other locally when they don't go through the central bank. One way is called the correspondent banking. Let's break it down. Say you have Bank A and Bank B. They want to settle money between each other. So what does Bank A do? It opens a nostro account with Bank B. What is nostro? Nostro is a Latin word which means our account with you. So when Bank A says that I have a nostro with Bank B, we are essentially saying that Bank A has money sitting inside Bank B. That account from Bank A's side is their asset. And of course, from Bank B's side, it's a liability. So now, if Alice at Bank A wants to send money to Bob at Bank B, Bank A just simply asks Bank B to take money from its nostro account and credit Bob. That's simple, right? But here's the problem. Bank A needs to open and fund nostro accounts with every bank their customers might need to bank with. That means Bank A might end up tying cash across 20, 30, 50, maybe 100 banks, managing all those relationships, risking losses if one of those banks fail. It's inefficient, it's expensive, and it just doesn't scale. So while correspondent banking works, it's not the best way to move money locally. And that's where central bank clearing system steps in, which is a cleaner, safer, and a more scalable solution. So instead of every bank connecting to every other bank, all banks can connect to one place, which is the central bank. Each commercial bank keeps a clearing account with their respective central bank. Before we talk about how central banks clear payments, let's talk about what are the different ways in which central banks clear payments. So basically, there are two main systems they use. One, the RTGS system, the real-time gross settlement system. Sounds complicated, right? But it's simple. Each payment is settled individually in real time. So when Bank A sends money to Bank B, the central bank moves the funds right away. The pros are it's fast, it's final, it's low risk because money actually moves instantly. On the flip side, it's expensive to run. Imagine how many transactions, thousands and millions of transactions are happening every single hour. And all those transactions are individually settled by the central bank between the banks. It's expensive to run, of course. Not every country or bank can support it for all transactions. For example, countries like the UK uses CHAPS, which is their clearinghouse automated payment system. The US uses FedWire, and the UAE launched its own instant payment platform in October 2023. What is the other model? The other model is called the DNS, the Deferred Net Settlement System. This one is more old school. So instead of settling each payment one by one, the bank waits, It batches all the payments at the end of the day and makes one bulk settlement to the other bank or between the banks. What are the pros? Of course, it's more efficient, it's simpler to operate, it's administratively light to manage, cheaper for the banks, and great for handling high volume payments. But of course, on the flip side, there are problems. It's slower, it carries more risk because if one bank fails before the settlement time at the end of the day, then other banks are exposed to a heavy credit risk. You might see the money, but it hasn't actually moved yet. So what happens today? Which system is actually used? In many countries, both systems run in parallel. You might think your transfer is instant, but behind the scenes, it could be running on DNS rails, DNS being Deferred Net Settlement rails. Or it might be RTGS if it's a large, urgent, or cleared through a premium system. Either way, there's a lot of communication going on between the banks. Messaging, confirmations, reconciliations, and all that just in a few seconds. So next time when you hit send, just remember there is a lot happening behind the scenes, and it is way more than just money flying through the air. So now, when Alice sends 100 dirhams from Bank A to Bob at Bank B, Bank A simply asks the central bank to move that 100 from its account to Bank B's account. Remember, both the banks are maintaining their accounts with the central bank. Once that is done, Bank B credits Bob. So there are no nostros, no bilateral deals, just one single hub. Now, that sounds perfect, right? Well, not for everybody. Because here's the catch. In some countries, not every bank is allowed to have a clearing account with the central bank. Usually, only the big banks get the privilege. So what do smaller banks do? They have to open nostro accounts with those bigger banks. And then those big banks settle through the central bank on their behalf. Of course, that service isn't free and the big banks charge a fee for that. And just like that, you have one more cost, one more delay, and more dependency in the system. Let's take an example. For example, the UK's RTGS system is called CHAPS. CHAPS is basically Clearing House Automated Payment System. Now, they only allow major banks to connect directly to CHAPS. The smaller ones have to piggyback off the bigger ones. So even with a single country, there is hierarchy, there is friction, and of course problems for smaller banks. And there is a steeper price to participate. Alright, let's make the discussion more interesting by throwing in some cross-border payments fun. Now let's zoom out for a moment. Central bank clearing is efficient. But the issue is that it only works within a jurisdiction, within a country, within the area of control of the central bank. Because there is no central bank of the world, not even the World Bank, however grand its name may sound. So what happens when money moves across borders? Is there a central bank of the world to clear those? Of course not. Before we go further, let's define what essentially are cross-border payments. And we'll do that with a few case examples. Case 1, currency enters its home zone. Let's say you live in the US and your friend who lives in the UAE wants to send you US dollars. Now here's the interesting part. That USD that your friend is trying to send you was already in the US. Wait, what? How is that possible? Let's pause here. Have you ever wondered how your UAE bank or your local bank can offer you a USD account or an account in any currency in which country it doesn't have a license to operate? Let's take an example. If you get a USD account from Emirates NBD, what does that mean? It basically means that your UAE bank holds a nostro account with a US bank. That nostro account is where the actual USD sits, inside the US banking system. So when your friend in the UAE sends you USD, what they're really doing is asking their UAE bank to transfer money from its nostro account, which it is maintaining with a US bank, to your bank account in the US. There could be two possibilities. If both banks use the same correspondent bank, for example, my UAE bank uses Citibank as the correspondent bank, and my bank in the US is also Citibank, then that's just a book transfer inside Citibank. But guess what? If your receiving bank, for example, my bank in the US, is a different US bank than the correspondent bank of my friend's UAE bank, then the funds move within the US from Bank A to Bank B, which are settled by the Federal Reserve, which is the central bank of the US. The bottom line, USD never leaves its domestic currency zone. As a matter of fact, no currency leaves its domestic currency zone. It just changes ownership from your friend's UAE bank account to your account in the US. Let's take another example. Now let's flip the direction. You are in the UAE and you're sending USD to a friend in Saudi Arabia. Here's how it works. Your UAE bank will have a nostro account in the US with a correspondent bank For example, JP Morgan, Citibank, or whatever. The Saudi bank also has a Nostro account in the US. It may be with the same bank, may not be with the same banks. If both banks, the UAE and the Saudi bank, use the same correspondent bank, say JP Morgan, the transfer is just the ledger update between the JP Morgan system from the UAE account to the Saudi account. But if they use different correspondent banks, then those US banks settle between themselves inside the US using their central bank clearing systems. Again, remember, the USD stayed in the US. The only thing that changes is which bank owns it now. Let's take one more example. Let's say now you want to send USD from your UAE bank to a Nigerian bank. And guess what? Both these banks are very small and neither has a direct relationship with a US correspondent bank. What must they do? Can't they move USD? No, they can move USD, but with an additional step of an intermediary bank. And here's what typically happens. Your UAE bank uses an intermediary bank, let's call it Big Bang X, who has access to all the US banking system. This Big Bang X routes your payment to the final US correspondent bank holding the USD. This intermediary setup adds more steps, higher cost, slower processing, and compliance risks multiply. And that Big Bang X, that's the intermediary bank. It doesn't hold your money long term, but it just bridges the gap. And here's the rub. Big global banks don't open nostros for everyone. Smaller banks often get left out. Why? Because they carry high compliance risk, low transaction volume, so smaller banks rely on layers of intermediary banks and they have to pay for it. Let's throw in one more curveball, which is the foreign exchange. So far, what we've been discussing was the same currency moving across border, in and out, between countries. We didn't discuss the currency conversion yet. So let's talk about what happens when there is currency conversion. Now, let's say you want to send dirhams from your UAE account to a USD account in the US. That involves currency conversion. And here is how it happens. Bank A, your bank in the UAE, would debit your AED account. Then it converts it into USD. This can happen in two ways. Bank A may convert it using its own USD Nostro balance, or it tells the correspondent bank to do the FX conversion. Then that USD is sent to the recipient's USD account. So again, AED leaves your account, it becomes USD. USD stays inside its domestic currency zone, which is USA. The currency never ever leaves its home. It only changes ownership. So what we can remember is that currencies don't travel, ownership does. So what's the closing line here? What's the problem that we're talking about? Let's zoom out for a second. Cross-border payments work, but with friction, especially when you're dealing with correspondent banks and intermediaries. And here's the reality. There are too many hops. Your money goes through too many cycles, 2, 3, sometimes 4 banks before it lands. This causes delays. Some payments take hours, some may take days. Costs add up. Every bank in the chain takes a cut. FX fee, spreads, compliance charges, and whatnot. There is lack of access. Small banks don't always get direct links, and they rely on bigger banks who don't always say yes. And the worst part? The system was never built for the world we live in today. It's patchwork. And that's where stablecoins come in. They are not just about crypto hype or speculative tokens, they are trying to solve this cross-border payments problem. A stablecoins lets you send your digital dollars or euros or pounds directly on a blockchain. No intermediaries, no RTGS, no Fed, no Nostros, just one digital wallet to another. Anywhere in the world, instantly, no working hours, no borders, no delays. So before we join the bandwagon of stablecoins buzz, it's important to understand what they're trying to fix. Because once you have seen the pipes underneath, only then you understand why the future needs a better plumbing. Thanks for watching.